Cash flow statement. Cash flow statement comprises of three parts: cash from investing activities, operating activities, and cash from financing activities. Cash from investing activities primarily indicates the capex which the company has done, the investments which the company has made in the subsidiaries. So through investing activities, we answer these three questions. How much money which has been deployed by the company as capital expenditure comes from cash from investing activities? This money has been raised in what manner? Has the operations been sufficient to take care of this capex, or did the company have to borrow or raise money by way of equity sources? If the company has been able to manage its capex based on operating activities, then what is the cash profit? Let us take you through the cash flow statement. This is an annual report of a listed company called Precision Camshafts. Dated annual report, it is a 2024 annual report. You can start from cash from investing activities. The total investments which the company has made in investing activities is 94 crores. This is rupees in lakhs, so it is 94 crores or 9440 lakhs. How this has been funded? How much operations cash flow the company has thrown up? 130 crores. What is the cash flow from investing activity? Negative 12.5 crores. So what we can infer from here? The operating activities cash flows are sufficient to take care of the company's investing activities and the financing activities. So we have answered the first question through the cash flow, which is this question: is the company making money or losing money? The answer is the company is primarily making money because it is cash positive. The next question which we seek to answer: how sustainable is the cash flow or the operating margins of the company? The total profit on a consolidated level for the year is 40 crores. Is there any other income or non-operating income? There is an exceptional items here. I can see 18 crores. Exceptional items are generally one-time items and they are not part of sustainable operations. So while the company has reported a 40 crores, out of that 1829 lakhs or 18.29 crores is exceptional items. So would it be fair to exclude these exceptional items to arrive at the sustainable cash flow? The answer is a positive yes. So the sustainable profitability of this company is 40 minus 18 based on last. In the prior year, there was no exceptional item, which means that between 2023 and 2024, the business has suffered some cost escalations which it has not been able to pass on to the customers, or the customers have renegotiated. Because last year the profit was 46 crores, this year the profit is 40 crores, but this 40 crores is after exceptional item of 18 crores. Through this, we have answered the next question, which is how sustainable is the cash flow of the company? Working capital efficiency, we can look at the balance sheet. Working capital is current assets minus current liabilities. So total current assets are 662 crores or 66,266 lakhs. Minus current liabilities is 266 crores. 400 crores of working capital, delivering a sales volume of around 1,031 crores. Which means that every rupee of sales increase requires the company to deploy around 40 paise of working capital. Let us see what has happened in the previous year. In the cash flow statement, we can see working capital adjustments. 151 minus 109, which is around 40 crores. This is a positive adjustment because the inventories have given a positive cash flow, means the inventory holding has come down. So again, referring the cash flow statement, the balance sheet and the P&L, the second principal question can be answered. Cost escalation we have already answered. Is there adequate liquidity to sustain any shocks in the near term? Cash balance which the company is carrying, 43 crores. Monthly fixed cost which the company is having in terms of salaries. From the profit or loss statement, we can infer what is the employee cost. So employee cost is 191 crores. The company is carrying a cash balance of around 40 crores, which means that it is carrying at any point of time roughly 4 to 5 months of salaries as cash, which means that the near-term liquidity seems to be okay. Even from a banker's perspective, there is a term debt. Company will require to hold 3 to 4 months repayment of term debt as surplus cash in order to be comfortable. Is the company regulatory compliant? The auditor reports answers that question in substance. The investor complaints, how they have been addressed. The report on corporate governance and internal controls, and the overall reporting of the company in terms of the notes to accounts and the schedules ensures that whether the company has been regulatorily compliant.